Most traders believe they are trading direction. They think the market is a decision between up and down. If they are correct, they profit. If they are wrong, they lose. That framework sounds logical, but it is incomplete, because accounts rarely collapse from a single wrong guess. They collapse from accumulated exposure inside misunderstood structure. There is a critical distinction most traders never articulate. Being wrong about direction is not the same thing as being wrong about activation. Let's slow this down. Imagine you believe Bitcoin will rise. You buy. Price drops. You were wrong. That is directional error. Now imagine something else. You believe Bitcoin will rise. You buy with high leverage. Price does not trend down sharply. It simply fluctuates. Up 0.6%, down 0.7%, up 0.4%, down 0.8%. Inside normal processing. Nothing dramatic. But your account swings violently. Not because the market collapsed, but because you activated too much transmission. This is not a prediction problem. It is a structural misunderstanding. Most traders look at a chart and see opportunity. They rarely ask, what environment am I standing inside? Is this expansion? Or is this compression? Is this transition? Or is this processing? They jump from observation to action. And they skip calibration. The market is not a straight line. It is a processing system. Sometimes it expands. Sometimes it compresses. Sometimes it stalls. Sometimes it rotates inside prior memory. And most account damage happens not during extreme moves, but during frustration, during waiting, during oscillation, during the period where nothing decisive happens. Why? Because leverage does not require large moves to create damage. It only requires fluctuation. And fluctuation exists in every structural state. You do not need a crash to destroy a leveraged account. You only need misaligned exposure inside a neutral zone. This is where most traders misdiagnose their problem. They think, I need better entries. But what they actually need is better separation between structure and activation. Before you ever click buy or sell, you must answer two independent questions. First, where is price being processed? Second, if price fluctuates normally inside this condition, how fast does my account react? If you cannot answer the second question, you are not trading. You are gambling on volatility. Phase 0 exists to reset this habit. We are not here to improve your prediction. We are here to improve your survival logic. From this point forward, structure will describe condition, exposure will describe activation, and risk will describe transmission. If you merge those three layers, you will confuse normal fluctuation with market betrayal. And the market is not betraying you. It is behaving normally. You simply activated too much sensitivity. That is the first correction. Let's move from theory to a real structural environment. Imagine CME Bitcoin during a typical trading week. New York session closes, Asia opens. Liquidity thins. Volatility narrows. Now we observe the following. Price remains inside the prior New York session range. Not above it, not below it. Inside. This is not random. This is structural processing. Now let's dissect what that means. Every session leaves a footprint. High, low, midpoint. Volume clusters. When price re-enters that prior session range, it is interacting with stored liquidity. This is not breakout behavior. It is memory interaction. Now most traders see price move 0.8% upward inside that range and think, momentum is building. But is it? If the move remains inside the prior boundary, nothing is transitioned. Structure has not changed. The location is identical. The distance traveled inside the range is irrelevant. Structure is defined by boundaries, not motion. If price is still inside the prior New York range, you are still in processing. Now let's differentiate two similar but different states. Compression. Price contained in a narrow band, volatility decaying, range tightening. Compression does not mean breakout. It means liquidity is balancing. Now imagine leverage inside compression. Small fluctuations repeat. Repeated fluctuations at high sensitivity create erosion. Compression punishes impatience. Rotation. Rotation is different. The range is wider. Price moves from top to bottom repeatedly. Wicks form on both sides. Traders interpret wicks as rejection. But wicks inside rotation are not signals. They are inventory shifts. Inside rotation, volatility is not small. It is repetitive. Repetition is dangerous at high leverage, because repetition compounds exposure impact. Now consider price briefly breaks above the prior session high. Traders react instantly. Breakout. But what matters is not the break. It is the sustain. Does price remain outside the boundary? Does it build acceptance above it? Or does it return inside the range within minutes? The first move is interaction. The second move determines state. Structure is not defined by touch. It is defined by sustained processing. If price breaks and re-enters quickly, nothing has changed. But exposure may have already been activated. That is the danger. Structure remained rotational. Exposure assumed expansion. Misalignment begins here. Now extend this scenario. Instead of a single session range, price remains inside overlapping ranges for 2 or 3 sessions. This is multi-session compression. Volatility decreases. Patience decreases. Anticipation increases. Traders increase leverage here because they believe expansion is due. But markets do not expand because traders are bored. They expand when liquidity imbalance builds. And imbalance cannot be predicted from duration alone. Inside multi-session compression, the longer price remains contained, the more traders increase sensitivity. This is where collapse chains begin. Not because structure is complex, but because duration amplifies impatience. Let's define 2 terms clearly. Rejection is not a wick. Acceptance is not a close. Rejection is sustained inability to process beyond a boundary. Acceptance is sustained processing beyond a boundary. If price moves above prior high for 5 minutes and returns inside, that is not acceptance. It is probing. If price remains above prior high and begins forming higher lows outside the range, that is structural change. Most traders cannot distinguish probing from transition. They activate exposure on the first sign of movement. But structure only changes when processing location changes, not when price moves. This distinction alone eliminates many unnecessary activations. Now combine everything. Inside compression, volatility is narrow but repetitive. Inside rotation, volatility is moderate and oscillatory. Inside confirmed expansion, volatility is directional. Each state demands a different exposure sensitivity. Yet most traders use constant leverage across all states. That is the core misalignment. You cannot use expansion level sensitivity inside rotation. You cannot use rotation level sensitivity inside compression. And you should not use compression level sensitivity inside confirmed expansion if your objective is participation. Structure defines volatility behavior. Volatility behavior defines transmission risk. If you ignore structural state and focus only on movement, you will misread noise as signal. And you will activate exposure at the wrong time. So before any position, ask, where is price being processed relative to prior session memory? Is this compression? Is this rotation? Or is this confirmed expansion? And then ask, does my exposure reflect that state? If structure is rotational and exposure assumes expansion, misalignment begins. This is not about being right. It is about being calibrated. Structure is the map. Exposure is the sensitivity setting. If the map shows processing but your sensitivity assumes breakout, Your equity will feel every fluctuation as threat. That is not a structural failure. That is a calibration failure. And calibration is your responsibility. We've clarified structure. Now we move into something far more dangerous. Exposure. Most traders believe exposure is confidence. It is not. Exposure is a sensitivity setting. Imagine your account as a sensor. The higher the leverage, the more sensitive that sensor becomes. Sensitivity is not intelligence. It is not skill. It is not conviction. It is response speed. If Bitcoin moves 0.5%, how much does your equity move? That is exposure. If Bitcoin moves 1%, how much does your margin compress? That is exposure. Two traders can stand inside the exact same structural location. One survives calmly. One panics. The difference is not structural understanding. It is exposure calibration. Let's remove emotional language completely. You are not entering a trade. You are activating volatility transmission. When you increase lot size, you are increasing fluctuation velocity. When you increase leverage, you are compressing survival space. And when survival space compresses, normal market behavior becomes intolerable. Now consider something simple. Inside a rotational range on CME Bitcoin, price often fluctuates 1% to 1.5% without transitioning. That is normal processing. Not expansion. Not breakdown. Just rotation. At 3x leverage, 1% is manageable. At 10x leverage, 1% is significant. At 20x leverage, 1% is dangerous. The market did not change. Your sensitivity changed. Exposure determines whether fluctuation feels normal or catastrophic. Most traders believe stress means they misread the market. Often, stress means they miscalibrated exposure. Let's go deeper. Exposure has three components: size, leverage, duration. Size determines fluctuation magnitude. Leverage determines fluctuation amplification. Duration determines fluctuation accumulation. Most traders focus only on size. They forget duration. A 1% fluctuation once is manageable. A 1% fluctuation repeated 5 times inside rotation creates erosion. Not because price trends, but because exposure amplifies repetition. That is why rotation is more dangerous than trends for over-leveraged traders. Trends are directional. Rotation is repetitive. Repetition compounds. Now ask yourself, do you adjust exposure when structure changes? Or do you keep it constant? Most traders keep leverage constant across all environments. They use the same sensitivity inside compression, rotation, and expansion. That is structural blindness. Exposure must adapt. Inside compression, reduce sensitivity. Inside rotation, reduce sensitivity. Inside confirmed expansion, moderate sensitivity may be justified. But exposure must follow structural volatility profile, not hope. Now let's introduce a second dimension. Exposure also affects psychology. If your equity fluctuates 3% per move, you remain analytical. If your equity fluctuates 20% per move, you become reactive. High sensitivity accelerates emotional decision speed. Emotional speed reduces structural clarity. Reduced clarity leads to further misalignment. This is how collapse chains begin. Not with dramatic crashes, but with amplified noise. Exposure determines how loud noise sounds. A normal fluctuation can feel like a crisis if sensitivity is too high. And once something feels like a crisis, behavior changes. Stops move. Size increases. Or positions close prematurely. The structure remains unchanged. Only your tolerance changed. So the real question before any position is not, is this a good setup? It is. What level of fluctuation does this structure normally produce? And can my account tolerate repeated exposure to that fluctuation? Exposure is not about maximizing profit. It is about managing transmission speed. If your account reacts faster than structure resolves, you will exit before structure completes. That is misalignment. Now imagine two traders again. Both see CME Bitcoin inside compression. Trader A uses 4x leverage. Trader B uses 15x leverage. Price oscillates 0.8% repeatedly. Trader A experiences mild fluctuation. Trader B experiences double-digit equity swings. After several oscillations, Trader B reduces clarity. Stress accumulates. The first minor expansion fakeout triggers emotional action. Trader A remains stable. Structure did not change. Sensitivity determined experience. Exposure is a lever on volatility. Pull it too far, and even calm markets feel violent. Keep it balanced, and even volatility feels manageable. Now integrate this with structure. Structure tells you the type of fluctuation likely. Exposure determines how intensely you feel it. If structure is rotational and exposure assumes expansion, you are mismatched. If structure is compressing and exposure assumes breakout, you are pre-activating risk. Calibration means matching sensitivity to structural state. Before opening any position, run this mental sequence. What state is the market in? What is the expected fluctuation band? What leverage converts that fluctuation into survivable equity change? If you cannot answer that last question, you are not trading structure. You are gambling on direction. Exposure must be a response to structure, not a response to emotion. And this separation, structure first, exposure second, is the foundation of everything that follows. Let's construct a neutral baseline. Assume an account size of $10,000. There is no bias and no opinion here. We are only working with structure and numbers. On the CME Bitcoin chart, price is rotating inside a prior session range. Assume the average intraday fluctuation inside this rotational condition is about 1.2%. This is not expansion, this is processing. Now we introduce exposure. Trader A chooses 5 times leverage. Trader B chooses 20 times leverage. Nothing else changes. They are looking at the same structure, the same volatility band, and the same chart. Only sensitivity changes. Trader A uses 5 times leverage. If price moves 1%, equity moves approximately 5%. Now imagine a normal rotational sequence. First, price rises about 0.7%. Then price drops about 1.1%. Then price rises about 0.6%. Then price drops about 0.9%. The net price change is small because rotation often gives back what it moves. But the equity response is not small. At 5 times leverage, that same sequence can feel like this in equity terms. First, equity rises about 3.5%. Then equity drops about 5.5%. Then equity rises about 3%. Then equity drops about 4.5%. After several oscillations like this, equity may be down roughly 3 to 6%. It is not pleasant, but it is survivable. In leveraged retail environments, margin conditions can remain stable enough to continue operating. Decision speed remains stable. Structure is still processing, and the account is still alive. Now consider Trader B, who uses 20 times leverage. Assume the exact same price fluctuation sequence. When price rises about 0.7%, equity can rise about 14%. When price drops about 1.1%, equity can drop about 22%. When price rises about 0.6%, equity can rise about 12%. When price drops about 0.9%, equity can drop about 18%. Now observe what happens. Even if price ends up near the starting level, equity volatility becomes extreme. After 2 opposing oscillations, the drawdown can exceed 25%. After 3 or 4 oscillations, margin pressure begins to dominate decision-making. This does not happen because a trend defeated the trader. It happens because repetition amplified transmission. Let's extend the scenario in a way that matches leveraged retail environments. In those environments, margin compression can force liquidation before structure transitions. Trader B begins with $10,000. After several oscillations, assume equity drops to $6,200. Now imagine price moves another 1.5% against the position while rotation continues. At 20 times leverage, a 1.5% move can translate into roughly a 30% equity impact. 30% of $6,200 is about $1,860. So equity can drop from $6,200 to roughly $4,300. At that point, liquidation risk rises sharply in many leveraged retail environments. The key point is not the exact liquidation threshold, because it varies by platform. The key point is that structure has not transitioned, but exposure has accelerated collapse. The market did not crash. It rotated. This is transmission misalignment. The real question is not, how much can I make? The real question is, how many oscillations can I survive before structure resolves? If structure remains rotational for 6 hours, can your equity tolerate repeated 1% movement? If not, exposure is miscalibrated. You must survive processing to participate in expansion. If exposure prevents survival, structure never has time to reward patience. Structure determines the volatility profile. Leverage determines amplification. Repetition determines erosion. If amplification combined with repetition exceeds your tolerance, collapse begins. This is mechanical, not emotional. It is not predictive. It is mechanical. Collapse rarely begins with panic. It begins with anticipation. A trader sees compression. The trader anticipates expansion. The trader increases leverage before a transition is confirmed. That is pre-activation. Structure remains neutral. Exposure assumes breakout behavior. Misalignment begins. Price rotates inside the range. Fluctuations are small. There is no clear direction. But equity fluctuates aggressively because sensitivity is high. Stress accumulates. The trader reassesses structure emotionally rather than analytically. Nothing catastrophic has occurred. But repeated swings reduce clarity. Once equity drops beyond a psychological threshold, reaction speed increases. Stops move. Position size increases in an attempt to recover faster. Or the trader exits prematurely. All of this happens while structure remains rotational. Transmission, not structure, drives behavior. Eventually, one of two outcomes occurs. Either a minor spike extends slightly beyond the average rotational band, or the trader voluntarily exits under stress. In both cases, collapse feels sudden. But it was gradual. It was built through oscillation. After the exit, structure finally transitions. Expansion begins. The trader feels betrayed. But structure did not betray the trader. Exposure prevented survival. This is the illusion. Timing feels wrong, but calibration was wrong. Here is the sequence in plain language. Compression appears, and leverage is increased too early. Rotation persists longer than expected, and equity begins to erode. Stress accelerates decisions, and the position is closed under pressure. Then expansion begins after the exit. This pattern repeats across accounts. Not because traders cannot read charts, but because they cannot separate structure from activation. Before any activation, follow this order. First, identify the structural state. Ask whether the market is compressing, rotating, or expanding. Second, estimate the fluctuation profile inside that state. Ask whether normal movement is closer to 0.5% swings or 1.5% swings. Third, convert that fluctuation into equity reaction. Ask what happens to your equity at your chosen leverage when a normal fluctuation occurs. Fourth, evaluate survival duration. Ask how many repetitions your account can tolerate before structure resolves. Only after these steps should activation even be considered. In sentence form, the model is simple. Structure defines volatility. Volatility combined with leverage defines equity reaction. Equity reaction combined with time defines survival probability. If survival probability is low, exposure must be reduced. Not because direction is unclear, but because transmission risk is too high. From this point forward, you do not ask, will price go up? You ask, what is the volatility condition? And you ask, is my exposure aligned with it? Exposure is not an expression of conviction. Exposure is an adjustment of sensitivity. The market does not destroy accounts. Misaligned amplification does. Structure is neutral, volatility is neutral, leverage is neutral. But when they combine improperly, they accelerate decay. This reset exists to separate these elements. Structure comes first, exposure comes second. Activation comes last. If that order is preserved, survival probability increases. And survival is the foundation of every advanced layer that follows.